All right, joining me is Roger Bayston, head of digital assets at Franklin Templeton, who's a $1.6 trillion global asset manager and a firm who continues expanding much deeper into products offering digital asset exposure, including a brand new ETF that just launched last week, the Franklin Crypto Index ETF, ticker symbol EZPZ, which that's a fantastic ticker. This owns both Bitcoin and Ether. Now, of course, Franklin also offers standalone spot Bitcoin and Ether ETFs, and they have an on-chain money market fund, which we'll get into. But Roger, it is a pleasure to connect. Welcome to the podcast.
Yeah, thanks for having us today.
Okay, so I thought let's just jump right in here, and I want to start with this most recent launch, the Franklin Crypto Index ETF. As I mentioned, this currently holds both Bitcoin and Ether. This is market cap weighted. Tell us about this ETF and why Franklin wanted to bring it to market.
Yeah, I mean, literally in its simplistic form, we are trying to make crypto easy peasy. Diversification, we think, is the theme of 2025. Just as is in all portfolios, in all asset classes that investors try to weave into their total solutions. We think that taking an index approach over the long term, where the index gets to be modified as new assets come into the environment, get approved by regulatory decision makers, flow into the index, and then therefore we flow them into easy peasy over time. Yes, it's starting with Bitcoin and Ethereum in market cap weights currently, but again, we think 2025 in the U.S. will probably see a lot of regulatory change and approval for additional assets to flow into the ETF wrapper, and then we'll be seamlessly be able to put them inside of easy peasy for clients' portfolios for their long-term, diversified, low-cost beta exposure to the asset class.
Yeah, and talk more about the regulatory environment right now. It certainly seems to be evolving right before our eyes. I'd love to hear your perspective on what we have seen over the past several months and maybe how you expect it to further evolve moving forward.
Sure. The Franklin Templeton Digital Asset Group has been engaged with the regulators for a number of years. You mentioned in the introductions that we'll talk a little bit about Benji, our on-chain money market fund. That required a great deal of hand-holding with the SEC for a number of years to get the permissions to use blockchain and the underlying transfer agency processes that we use in issuing securities and funds. And so we've been wrapped inside of conversations with regulators for a good bit of time. Of course, new administration, new leaders, teeing up lots of new legislation coming through in the next weeks and months that we expect that is going to propel forward at least the U.S.-based businesses and operators in blockchain and digital asset environments to kind of put them on a level playing field with what we've seen really across the planet in some other jurisdictions.
You know, it's interesting on this note of the evolving regulatory environment. I saw just this past Friday that Franklin filed for a Solana ETF. And I know because this is a live filing, you can't speak to that directly, but I would be interested in hearing how Franklin views digital assets beyond just Bitcoin and Ether. Like, how do you evaluate which digital assets might have value and which ones might be suitable to bring to market in an ETF wrapper?
Yeah, you're right. We can't really talk about our filing for So Easy. Playing off of trend there, you see that, don't you? How we're trying to
very clear
messaging there. Yeah, when we're thinking about the entire ecosystem, I guess our learnings and our work in organizing and offering advice on the growing array of digital assets, it really stems from the fact that we began the journey in just trying to apply blockchain technology in a core part of our business. We were attentive to the words distributed ledger technology, ledgers filling asset management and capital markets, something both opportunistic and disruptive certainly was happening. We wanted to pay attention to that. And we had the idea that we would use for one of our very largest databases that we maintain, the transaction records for our mutual fund business. We maintain those in monolithic centralized database systems as part of the transfer agency process. We just proposed maybe replacing that monolithic centralized database system with public blockchain infrastructure. And as we started that journey, we identified massive efficiency gains for doing that, and then increased utility as well. We decided to start with a money market fund specifically. But all of this meant that we have been very deep in developing digital wallet infrastructures, digital wallets that approve, that passed approval process through our regulators, both in the U.S. and globally. So these wallet infrastructures ride on a number of different public blockchains. We've become to know very intimately the tokenomics of some of these blockchains. I mean, in order to use these blockchains, we need to spend the cryptocurrency to put the record on chain. We earn the cryptocurrency by running nodes on the networks. So we begin to embed ourselves in those economies. And that all really helped us to unfold an understanding of which of these networks and environments are likely to continue to hold and to be serious capital markets for investors. And that is a word choice that I'm using, capital markets. We've had some adjustment in prices over the past couple of weeks, but at roughly $3 trillion US, crypto is now as big as the high yield bond market, which took some 40 years to generate. And so there is real capital market activity that's going to continue to happen. There will be robust lending markets that develop, institutional lending markets that develop around this stuff. And so inside of those capital markets, we want to be able to offer simple products that allow investors to weave these into their portfolio solutions for the long term, because we think this is an important ecosystem, not just for asset management and financial markets, but we see the information-based economy using blockchain ledger and blockchain networking technology to build and expand opportunities.
Going back to the Franklin Crypto Index ETF, I'm curious why you think an index-based approach can be valuable when it comes to crypto. And before you answer that, I'll tell you, I've heard some people say, it doesn't make sense to own Bitcoin and Ether in the same fund. These are completely different assets with very different use cases. Now, I see that as diversification, right? I personally believe that can be a good thing, but I'm curious how you think about an index-based approach to crypto. And I bring that up here just after you went through, how Franklin is evaluating the different blockchains and the different digital assets that power those blockchains in the market. I'm just curious how you think an investor should view about accessing those digital assets overall.
We think there's a number of different investment opportunities that come to bear here, but we've known, and do know that a large amount of investors just, want exposure, and then they also want to be able to possibly get discretionary opportunities around some of the exposures. And so we're just taking the position that in the long term, these are going to be important capital markets. And we want to have a depth of products that meet investors where they are. Historically, it's been very expensive to invest in crypto between all of the different service agencies that you might be involved in. And so we're bringing that cost way down for investors to be in that journey. Ultimately, it's about understanding the ability to invest in network economies by and large. And, Bitcoin itself is a network economy. Ethereum is a network economy. Solana is a network economy. All of these have different use cases. Combining them into a diversified portfolio just seems to make sense as we march forward and, embed these in a number of different opportunities, whether they're, in payments or in, kind of store of value. These are technologies that will continue to evolve. They're not static technologies. And so in some cases, you're not just investing in what is here now, but what the possibilities that they might become as well.
You mentioned bringing the cost of accessing digital assets down. I think we should mention here that EZPZ is only 19 basis points, and actually Franklin is waiving that fee until August 31st. Of course, your standalone Bitcoin and Ether ETFs, those are also only 19 basis points. How does Franklin think about fees when it comes to digital asset ETFs?
Well, we think, again, there's places for investors in their portfolios to have passive index approaches. We offer inside of our ETF complex a number of those. We think that's appropriate here now, and as we continue to watch the landscape unfold, where to weave in that advice into other products and services that we might bring to the marketplace.
In
But
terms
clearly,
of
the price is right at 19 basis points. Trying to make investing, in crypto easy peasy at 19 basis points feels like a grand bargain.
when you look at investor demand across digital asset ETFs, of course, spot Bitcoin ETFs have seen significantly more interest in spot Ether ETFs. Now, Bitcoin ETFs did have about a 6 month head start, and obviously Bitcoin has a much larger market cap. But I'd love to hear your thoughts around investor demand. I've heard some analysts suggest there's a much steeper learning curve with Ether, right? It's not necessarily as easy to understand as, say, digital gold. And so maybe that's crimped demand a bit. Just any thoughts around the demand we've seen thus far for Bitcoin and Ether ETFs?
Well, I think the big unlock that is going to need to bring the proof of stake networks like Ethereum on par with kind of the Bitcoin ETFs is the regulatory acceptance of staking as a added feature onto the ETF. That has not yet been approved, but we know that in proof of stake networks, I mean, there's a lot of yield or earnings that is left on the table if you are not staking your proof of stake kind of cryptocurrency. And so I think that these products, the Ethereum ETFs, have had a disadvantage versus just holding Ethereum in another format because you're not earning that staking. It's almost like owning a portfolio of dividend paying stocks and not taking the dividends. It's very akin to that. And so, but again, we know that these are conversations. These are conversations we are having with regulators. There's many parties who are doing that. Bringing them up to speed about how we think of staking inside of the context of current securities laws, or how to adapt those in order to allow staking in these networks to be able to be used inside this ETF wrapper. I think that's another thing that will be a problem and or a challenge that will be solved in 2025, which will probably increase the use cases of both Ethereum ETFs as well as any other proof of stake networks that get to be approved and flow into benchmarks like our CF benchmark, and then EZPZ as well.
Any thoughts just on investor demand for products that hold multiple cryptocurrencies? I've said for a long time that the end goal here, at least in the ETF space, is to have index-based and actively managed digital asset ETFs, right? But what's interesting is that if you look on the stock and bond side of the equation, of course, index-based approaches are extremely popular. That's where the vast majority of flows are going. But, I think some people assume that maybe flows will only go into the standalone spot products. Any thoughts around that?
Well, I mean, that's a hard thing. There has not been diversified, portfolio multi-coin approaches to date until now. And so, looking backwards, yes, they're thinking that that's where the flows are going to go. Again, at $3 trillion versus $100 trillion market cap of public markets, advisors or large investors who are not participating are actually now making an active decision to be out of crypto. And so we think that's all changing. These are indeed capital markets. There's significant capital being raised in these markets that will be deployed to commercialized opportunities where there will be revenues, there will be earnings. It's really about how the networks translate those revenues and earnings in their tokenomics that is really ground level work that we do in offering advice in this space to investors. And so these are things that are unfolding in front of us. It's a pretty exciting time, quite frankly. When do you get to see a new capital market grow up just in front of your face over time? I mean, I've been in business now almost 40 years, and the times that these have occurred are not that frequent. So we're taking full advantage.
All right, so this is a perfect opportunity to talk more just about the future of tokenization. And you touched on this a little bit earlier, but I think we have to start by talking about the Franklin OnChain U.S. government money market fund. That's ticker FOBXX. Do you want to describe how this fund is structured and just what it means to be on chain?
Yeah, let's because it's a tokenized money fund, people tend to get a little bit confused about it. It is just a money fund. It is nothing more boring than a U.S. government money market fund. I mean, literally, is there anything more boring on planet Earth than a government money market fund? But when we started our journey into how do we how we might apply blockchain technology, we focused on money funds. And, sometimes you can be smart, sometimes you can be lucky, sometimes you can be both, because this project really started back in a macroeconomic environment of zero Fed funds rate. So, money market funds weren't paying any yield either. But we just were wise enough to know that, money market funds are part of M2, money supply. They have been woven into the transactional economy through check writing and debit cards for a long period of time. And so we were just wise enough to say, hey, if we're going to problem solve for our $1.6 trillion asset manager, if we problem solve in a product that has a higher velocity of shareholder activity, then we're going to be able to apply that across the other depth and breadth of services that we have. And so we started that process, and essentially what it means is that we are, when you own Benji, FOBXX, you just own a token inside a digital wallet. That's your expression of owning a share class of the fund. Now, okay, so what's so really different about being able to do that versus kind of the legacy transfer agency process? Because that's the other thing that people, the term tokenization feels, really interesting and, complex. But really all it is weaving the share class registry onto a public blockchain inside of the transfer agency business. Those people who are in the securities related business will be able to understand those words and be able to take them to heart. What are the features that it has unlocked for us by being on chain? Well, Roger can send to Nate, Benji, and that transfer will happen as fast as the record can be recorded on one of number. Currently, I think we're on 8 public blockchains that we're currently on. I mean, sometimes that is in fractions of a second that can happen. So you think about that. Roger sends an interest-bearing asset, to Nate almost on a real-time basis. And, rather than Roger having to liquidate a money market fund, put money into cash, fiat, use Zelle or Venmo, send it to Nate's account at Zelle or Venmo, and then he, reinjects it back into the system. Now, in an individual, that sounds like super interesting, but if you think about that institutionally, when you're talking about trillions and trillions of dollars across planet Earth wrapped inside of money market funds by institutional, holders who want to protect and have fully collateralized liquidity, that's a really, really powerful feature set. And you combine that on something where we have actually a patent pending that we're calling intraday yield. When Roger sends Nate Benji at 9 o'clock in the morning, literally at 9 o'clock and 1 second, Nate begins to accrue the interest on the asset rather than waiting for the 24-hour cycle to turn over. So the composability of the public blockchains make them a much better environment for taking plain, super boring, plain vanilla U.S. government fund and taking it to be kind of money of the future, quite frankly.
So let me ask you this. Do you think longer term, and I think I know how you might answer this, the future of all securities is on chain? Is something like FOBXX simply the first step, down the path towards all funds being tokenized, or is that pie in the sky?
I think you're going to end up with a kind of a potpourri or menagerie of systems. There's nothing wrong with the current systems, right? We have trillions of dollars in brokerage accounts that work on the current systems and rails. Will that all eventually be converted? It's possible, but it's really only where there's going to be new and interesting utility for customers and clients. I mean, we can see some of those use cases. And of course, now we have all of this visibility about how AI can help complement the things that we all do on an everyday basis. You can imagine as AI gets woven into things like asset allocation and moving money around, and you're not having as many, more of that is programmable, that those possibilities exist. So I think the real unlock that's encouraged me to be in this space is not about whether the entire existing ecosystem gets changed over. And I do think part of the president's executive order was to say this 3 trillion market cap industry is now going to be able to go after this 100 trillion public market infrastructure. I think there's going to be lots of interesting deals that happen as a result of that. There's a lot of space, but more importantly, I think blockchain technology and generally tokenization is going to increase the opportunity set for investors. So we think about shifting up the efficient frontier rather than just going out the risk spectrum. In fact, I think it's also going to allow us to thinking forward about, the world is not a two-dimensional situation. We've been working in two-dimensional risk return for the better part of 50 or 60 years in finance. I think the world is 3, 4, 5 dimensions, and I think we'll begin to optimize client portfolios across multiple dimensions. There's actually not a tangent line, but there's a whole plane that exists inside of those multi-dimensional worlds. Whether people want they want their investments to have impact, for example, would be an example. How do we begin to measure impact? How do we include that as one of their objectives, and then actually also be able to measure that? I think those are all possibilities. So it's not about tokenizing necessarily the existing public and private securities markets. I do think there will be a lot of that happening, but I think it's also how do we crack open the opportunity set of investments that haven't yet been possible, but these technologies actually make possible.
Well, I think after hearing that, we're going to have plenty to talk about moving forward. Roger, really enjoyed the conversation this week. I certainly wish you continued success as you build out Franklin's digital asset offerings. Thank you for joining me.
Yeah, thanks. We look forward to helping make crypto easy peasy. Thanks for having us.
That was Roger Bayston, head of digital assets at Franklin Templeton. Hope everyone enjoyed this episode of Crypto Prime. Please leave a review or give us a like wherever you're listening or watching. I always appreciate the support, and I'll see you again next week.
Crypto Prime is hosted by Nate Geraci, president of OTR Media LLC. Nate is also president of the investment advisory firm The ETF Store. While OTR Media LLC and the ETF Store are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by the ETF Store. This program is for informational purposes only and does not constitute investment advice. Investing in crypto assets involves substantial risk, including the potential loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Visit CryptoPrimePodcast.com for more information.